All right. So, do you have a financial blueprint? All right. You may or may not. You want to be able to set goals regarding retirement with what? With what? Set goals with confidence. There's nothing like confidence in retirement. If you talk to people that are retired or on the verge of retirement, there was or there is a lot of fear. Fear is a word that may not be used directly, but man, you can see it in other people's eyes. There is fear. Fear they're going to run out of money. Fear that there just isn't enough. Fear that they're not going to be healthy enough to do everything they want to do, and on and on. Fear is real. The struggle is real. That's why you need a blueprint, because a blueprint keeps you on the straight and narrow. A blueprint is something you can follow. And even if you get punched in the face, you can recover because you can get back on to the plan. So let's talk about this plan. You want to create your own detailed plan for financial freedom, not someone else's. You can use other plans and other blueprints, but that's not your life. Your life is your life. Your retirement is your retirement. Everyone is at least a little bit unique. I'm unique, you're unique, retirement's unique. I see this over and over again with all my conversations with entrepreneurs, with the people in my family, with close friends. Retirement is different for every single person for a huge number of reasons. If you're interested, comment below. All right, so we're going to cover three things in this video: the magic number, portfolio design, and healthcare costs. So number one, the magic number. How much do you need? Everyone wants to know, how much do I have? How much do I have to have? How much do I need? And do I have enough? It's all really the same question. Have you stored up? Have you saved enough money? And related to that, will I have enough cash coming in from dividends, interest, from selling down stocks, from annuities, from my pension, Social Security, and so on? Okay, how much do you need? Let's talk about it. There's a very simple rule out there which is reasonable. So let's use this reasonable rule. It's called the rule of 25. Okay? Multiply your annual expenses by 25 to estimate your retirement magic number. Right? It's so ridiculous. Right? But 25 times. And why is that? I'm going to give you the math behind it in as simple a way as possible. If you take 4% of 100, you get 4. So 4% of 100, you get 4. If you want to go from 4 to 100, you multiply by 25, right? So imagine having $100 and you only need $4 per year, okay? So you have $100 in the bank and you only need $4 per year. That means you only need to make 4% on your money, because that's $4. 4% of 100 is 4. So if you invert that, again, fast math, 4 times 25 is 100, hence the rule of 25. Hopefully that didn't confuse you too much, but really it's, 1/25 is 4%. Invert it, rule of 25. So again, that's your magic number. It's not perfect, but it's also, there's something cool about this. There is the 4% rule about being able to take money out, take 4% out of your portfolio and being able to live on that. We'll talk about that more in the future. But there's another part of this too. If you have 4% dividends on all your money or 4% interest on all your money, then you'd be able to retire. You'd be able to retire as long as you use the rule of 25 to go, okay, well, I need $10,000 per year, let's say. Let's just make it simple. So you would take 10,000 times 25 and get, what is that, 250,000, right? So you'd get so if you have 250,000 and then 4% of that, that's going to be 10,000. Again, you don't need to worry about the math. Just make sure that you use what we talked about in the previous training. Hint, go back and look at part 1. Know what your expenses are, know what you are actually going to need, understand that, and then you can multiply times 25 and it tells you, okay, 4%, we're in pretty good shape. So again, that's related to the 4% rule, and that's how you can withdraw annually without depleting your savings. In other words, the 4% rule, which you probably know about if you know anything about retirement, lets you know that roughly speaking, even though it's kind of crap, if you talk to a lot of financial advisors, they'll tell you that the 4% rule as a hard and fast rule is crap because it doesn't properly take inflation into consideration. It doesn't properly take into consideration the variability in the market, the changes, sequence risk. If you take out too much too soon, things go to hell in a handbasket. But it does give you a rough and simple way to understand, because it shouldn't be too hard to generate 4% on your portfolio in general, and therefore you can multiply times 25. At the same time, the 4% rule does give you an idea about what you could sell down or what you would need in terms of dividends or interest, or some combination. Sell a little bit down. Also, you could get some dividends and interest. Another part of this is that I'm not even talking about pensions. I'm not talking about Social Security. I'm talking about just like a Scrooge McDuck level of cash, right? Your retirement cash hoard that you're diving into. Maybe it's more like you've got a little pinchy of that, and that's perfectly fine. Deal with the reality, handle it, and move forward. Okay, Social Security, speaking of that, you want to separate the myths from the reality and actually calculate your benefits. So instead of guessing, oh, I'm going to get $2,000 a month or $1,500 or $2,500 or whatever the number you think it's going to be, go to the Social Security site and run the numbers, get the numbers, and make sure you track that. Go and take a look, about once a year. It's free to log in and check that out. And then you can add that in. You can start to really think about the plan regarding Social Security if you haven't started to withdraw it yet. And yes, you can early withdraw, and yes, you can withdraw late, and yes, there are required minimum distributions, and yes, there are exceptions, and what about my wife? What about my husband? And so on. So you have all these nuances. You're not starting with that with your plan. You're beginning with things like, what am I spending? And also I'm going to multiply times 25 to see. I'm going to think about the 4% rule. I'm going to think about what kind of money my portfolio spits off. This is all of critical importance. Even if you don't get it quite right, you're building that plan. And that is what is critical, my friend. Okay, so the magic number, how much do you need? I've given you an idea. We're going to be covering this in greater detail in other videos, but this gives you the initial sort of lets you sink your teeth in, right? Right, and the fangs, right, and the claws as well. Okay, magic number. Number two. All right, portfolio design for peace of mind, because a lot of retirement is very, very, very much about the mind, right? Mental health and keeping your head on straight and not going completely bonkers. Okay, so peace of mind. Asset allocation is your friend. So what is asset allocation? It's really where you're putting your money, rather than concentrating and focusing just on, let's say, cash or CDs or bonds. How about all of those? What about stocks, bonds, cash, and so forth, right? So you want to have your money in a variety of places, not too many. You can get a lot of diversification really fast with an S&P 500 index fund or a bond index fund. So that alone can give you an awful lot. You can throw in gold, you can throw in various commodities, you can throw in Bitcoin, woohoo, right? So you can throw in a whole bunch of different types of assets and then allocate accordingly. Now, we do have other videos on the Rhodes Brothers channel where we talk about portfolio creation, portfolio allocations, risk mitigation, stuff like that. What I will say is that diversification is your friend. What I will also say is think about your investments in terms of buckets and keeping those buckets roughly the same size once you've determined how big those buckets ought to be. The buckets will also adjust over time. You might want to get less conservative over time because your portfolio is growing like crazy. And so it's like, well, double down, or the exact opposite. Maybe you need to get more conservative over time because your money is running out faster than you expected. So there's lots of reasons why the buckets themselves might adjust. In other words, the asset allocation might end up needing to be changed, but don't change it rapidly. Don't sell when the market is panicking, and don't buy when the market is skyrocket high. Don't do it. It doesn't make any sense to do that. Keep your head on straight. Okay, asset allocation, buckets, diversify. This is stuff that you ought to know about. If you don't, leave comments below because I can help you. I can point you in the right direction for what is portfolio allocation. What books should I read? I can give you 4 or 5 books very easily. I can do that in the comments below if you're interested. We need to press on though, so let's do that. Okay, another thing you want to be doing is stress testing your portfolio. If you have loads and loads and gobs of money, you can go to someone and they can run Monte Carlo simulations for you. You can buy software or talk to a financial advisor and you can run these simulations. You can do it online as well. There are some tools that are out there. The key is Monte Carlo simulations, and you can put certain amounts of money in, drop in your own assumptions about things like, what's inflation going to be like? What about taxes? What happens when Social Security kicks in? At what age, what date? Things like that. And these Monte Carlo simulations basically should give you an indication of how likely you are to make it all the way to retirement, the end of retirement, and still have money. That's kind of a lie because there's more to it than that. People that aren't making ends meet with their retirement funds very often will do what? Adapt. Humans are very, very clever creatures. That's for sure. And you are likely to adjust as time goes on. That's everything from the buckets and your diversification all the way through running these Monte Carlo simulations and what it actually means. Humans are adaptive. Plan on adapting to the upside and to the downside. Volatility is real. Volatility on the upside, that means woohoo, markets are going crazy and great. That's good for you. Markets plummeting, crashing, dying off. That's important as well. So having like emergency savings is a big, big idea. All right. Making sure you have credit available so that you're not dipping into your investments. Maybe it's part of what you've got asset-wise in terms of your mortgage or not your mortgage, it could be your mortgage. It's a long story. Reverse mortgage is what I was thinking. Also tapping into home equity in a variety of ways. You can borrow against your portfolio. Lots of ways of making this stuff work. Beware leverage. All right. If we don't know what leverage is, leave a comment below. I'll talk more about leverage, or maybe I'll shoot an entire video about leverage. Okay. So ridiculous. Okay. Next, when and how to rebalance your investments for sustained growth. So this is about your adaptability. The thing that most people don't remember to do is think about their why. They don't think about what they really want out of the retirement time that they've got, and they aren't connecting properly with their goals. But you want to be rebalancing not just for the sake of cash and cash flow. That is of paramount importance, certainly. But when you make these adjustments, a key part is connecting your cash flow, the money coming in, and your assets and your allocation to what your goals are. You might be going like, what the hell is he talking about? What I'm getting at is, let's say as time goes on, you're like, I want to leave money to this charitable foundation. You didn't before, now you do, right? So if that's the case, if it's truly the case that you want to leave money behind for the kids and the grandkids, do they deserve it? I don't know. Maybe, maybe not. Anyhow, connect the money, the cash flow, the assets, the diversification, the buckets, all of it. Tie it to your goals. All right, so that's the second thing. The third thing, and this is the insidious trap of retirement, really of growing old is what it is. Okay, when you get old, health starts to decline. Now, some people are able to improve their health after they retire for a variety of reasons, more exercise, better eating, all of the above. You know it, I know it. You can lose the weight, drop the pounds, maybe miracle drugs. I don't know, possibly, but healthcare cost regardless. Nevertheless, they're going to be very, very big in your life at some point in time, or a loved one, right? So maybe it's not you, but it's going to be a loved one. Your family is going to face some kind of healthcare something. Do I call it a crisis? I don't know, but healthcare, the struggle is real. Okay, so understand Medicare basics, start to look into that. Again, I can make some recommendations, drop a note in the comments below. I have some thoughts on that and where to go and where to get more information. But the key is that you need to look into what Medicare is, what the nuances are, why and how it's right for you, and what you need to do above and beyond Medicare. Supplemental insurance, for example. I do want to point something out. 65% of bankruptcies are tied to medical issues, medical emergencies. That's 2 out of 3. 2 out of 3 bankruptcies are related to medical issues. Just something to keep in mind. The medical cost in your life, especially in retirement, it's real. So again, understand Medicare enough now as part of your financial blueprint and setting things up so that you're not caught unawares. Okay. Second part of this is it might make sense to save for long-term care insurance. Lots of ways to think about this. You're going to have to do your research depending on your family history, your age, spouse, husband, wife kind of thing, beneficiaries, all of it. You're going to want to be thinking about who can take care of you. Does it have to be professional? Can you do it in home? What are you actually planning when it comes to your options and strategies? All right, so the third thing here now related to this are healthcare savings accounts or HSAs. All right, so these are they're great because they're like triple tax protected. So it's really awesome. The money goes in tax-free, grows tax-free. You can take it out tax-free. Don't take my word for it. I am not an accountant. I'm not a CPA or any of that. I'm not a financial advisor. This is a tax thing. It's not investment advice or otherwise, but you can really do great things with these HSAs, right? A high deductible type of insurance plan. You do need to be, let me be specific about this. At this point in time, you need to be enrolled in a high deductible healthcare plan. But here's the deal. This is one of the things that the ultra wealthy do, okay, is they set up an HSA and they just keep piling money into the HSA. And they don't take the money out of the HSA until they really, really need to way down the line. Why would they do this? Number one is they have enough money saved in emergency savings, and they even pull it from other sources. Why? They do it so that that money can be continue to be triple tax advantaged. Again, I'm not a CPA, any of that, but look into this because it's like, whoa, secret back door, right? Loophole. The money goes in tax-free. It compounds tax-free, right? And then you can take it out tax-free. So HSAs can be wonderful. There are many stipulations, many issues, many problems with it, but it is something for those people who have high deductible plans, can afford lots of cost in terms of healthcare. Right now, in the here and now, the tax advantages can be substantial. Again, that's all part of everything I just covered is part of your financial blueprint. We covered the magic number. We covered the portfolio design for peace of mind, mental, and also preparing for healthcare costs. This is a big deal. All right. Please subscribe to the Rhodes Brothers channel. This is Greater Wealth Through Mastery. I am John Rhodes. My brother is Matt Rhodes. We are here to help you in so many ways. Look in the description below. We have great material for you. If you're thinking about retirement, if you're looking into it, when it comes to money and finances, we care very much. We also care about artificial intelligence. We care about your mind, your thinking, being an entrepreneur, so much more on this channel. Please like this video. Again, subscribe, leave comments. Your interaction is so valuable. We appreciate you so much, and we'll see you in the next video. One thing I'll tell you, since you're here, right? Next, the lifestyle map, crafting a retirement you love. So now we get into, wow, enjoying retirement. That's going to be episode number 3. That's the next video. We'll see you there. Thank you. Take care.